As of right now, Tuesday, March 31, 2026 at 1:57 p.m. Eastern Time, BigBear.ai stock is trading at $3.12 per share, marking a slight intraday decline of 0.64% from the morning's open. While the broader indices are showing a bit of a mixed bag today, BigBear.ai is sitting in a fascinating spot where the market's immediate reaction seems to be one of cautious waiting, yet the underlying mechanics of the company are shifting in a way that most retail investors completely overlook. Most people see a $3 stock and think of it as a speculative play or a lotto ticket in the artificial intelligence space, but the reality is that the company has spent the last year quietly cleaning up its balance sheet and moving away from the zombie company narrative that plagued it in 2024. The expectation from the general public is that this is just another small-cap AI firm struggling to find its footing against giants like Nvidia stock. But the reality is a story of extreme financial deleveraging. When you look at the landscape of online investing today, there is a tendency to focus on the flashy, consumer-facing AI. However, BigBear.ai operates in the shadows of national security and defense, a sector where the barriers to entry are massive and the contracts are sticky. While many are looking for investment help through various investing sites to find the next moonshot, they often miss the nuance of how a company like this has managed to reduce its debt by more than 90% over the last 12 months. We are seeing a fundamental shift from a company that was once burdened by high interest notes to one that now holds a record cash position. This is the classic tension between expectation and reality. The expectation is a struggling penny stock. The reality is a lean, well-capitalized entity with a massive backlog that is starting to benefit from the modernization of government data architecture. If you are using a platform like the Robinhood app or looking at your individual brokerage account on Fidelity, you might see the volatility and feel uneasy, but the institutional activity we have seen recently suggests that big players are paying attention to the $376 million backlog the company is sitting on. This isn't just about AI as a catchphrase, it's about decision intelligence. Think about the complexity of managing global supply chains or autonomous command and control for the Army. That is where BigBear.ai lives. They aren't trying to build the next chatbot for your phone. They are building the brain for high-stakes, mission-critical operations. This brings us to a point where we have to ask, at what point does the market start pricing in the actual stability of these federal contracts versus the speculative fervor we see in things like Tesla stock or Apple stock? In the world of online investment, it's easy to get distracted by the high-flying names, but companies like BigBear.ai often provide the most interesting case studies in turnaround logic. Just recently, the company closed its acquisition of Ask Sage CargoSeer. These weren't just random purchases, they were strategic moves to bolster their presence in the Middle East and in the travel and trade sectors. If you are managing your own funds through a SoFi robo-advisor or a similar tool, these are the types of fundamental shifts you want to see. The company is projecting 2026 revenue to land between $135 million and $165 million. When you consider where they were just 2 years ago, that kind of growth is significant, yet the stock price remains suppressed because of the guilt by association with other failed SPACs of the 2021 era. Let's get real about the risks, though, because no analysis is complete without them. The heavy reliance on the U.S. federal budget is a double-edged sword. We saw this clearly when government contract disruptions led to a revenue dip in late 2025. If the government delays its spending or shifts its priorities, BigBear.ai feels the pain immediately. This is why you see the stock trading at a fraction of its 52-week high of $9.39. There's a massive gap between the potential for $8 per share that some analysts suggest and the current $3 level. The market is effectively demanding that the company prove its profitability before it awards it a higher multiple. If you are self-investing through interactive brokers or using the Fidelity mobile app to track your trades, you have to decide if you believe the company can bridge that gap. The institutional sentiment is starting to lean toward cautiously optimistic. We are seeing more mentions of BigBear.ai in the context of Fidelity mutual funds and other managed products that look for small-cap exposure with a defense tilt. Unlike some of the more speculative meme stocks you might find on the Robinhood trading platform, BigBear.ai has a real, tangible product used by 27 different government agencies. That doesn't happen by accident. It requires years of vetting and security clearances. This is the moat that people talk about. It's incredibly hard for a startup to walk into the Pentagon and say, "We have an AI for you." BigBear.ai is already in the building. I want to pause here and get your take on this specific sector. Comment below how many shares of BigBear.ai you currently hold, or if you prefer to stick to the larger players like Nvidia stock for your AI exposure. Do you think these smaller defense contractor-style AI firms have a better chance of long-term survival than the consumer-focused startups? I'm curious to see what the community thinks about the risk-to-reward ratio here. Now, to understand why the stock is moving the way it is today, we have to look at the business model. BigBear.ai operates through two main segments, cyber and engineering and analytics. They provide high-end consulting and software solutions that help leaders make decisions when there is too much data to process manually. Think of it as a layer of intelligence that sits on top of existing data systems. They've moved toward a more software-heavy mix, especially with the Ask Sage acquisition, which is expected to bring in significant recurring revenue. Recurring revenue is the holy grail for investors using investing sites to screen for quality stocks because it provides a floor for the valuation. Historically, the company has had its fair share of struggles. After coming public via a SPAC, it faced the harsh reality as many others: high costs, slowing growth, and a skeptical market. But the management team has been aggressive in 2025. They raised nearly $700 million through share sales and used that capital to pay down debt and fund acquisitions. While that did result in some dilution for existing shareholders, it fundamentally saved the company from a potential liquidity crisis. When you are looking at your intelligent portfolio or using a SoFi active investing account, you have to weigh that dilution against the increased stability of the business. A company with no debt and $87 million in cash is in a much better position to weather a recession than a company with $200 million in debt and $10 million in cash. Looking ahead to the rest of 2026, the catalysts are clear. We need to see that revenue growth translate into positive adjusted EBITDA. The company has already started 2026 by settling its remaining 2029 notes, meaning the interest expense that was eating away at their bottom line is largely gone. This clean slate is the reality that is slowly starting to overtake the expectation of failure. If the company can hit the midpoint of its $150 million revenue guidance, the current market cap of around $1.45 billion starts to look a lot more reasonable, especially if they can show that their gross margins are expanding back towards that 30 to 35% range. In terms of the technicals, the stock has found a bit of a floor around the $3 mark. We've seen significant volume on the Robinhood app and other retail-heavy platforms whenever it dips near its 52-week low of $2.36. This suggests there's a strong buy-the-dip mentality among retail investors who see the long-term potential of AI in the defense sector. Meanwhile, on professional platforms like the Interactive Brokers Trading Desk, we see a more measured approach, with institutions waiting for the next quarterly report to confirm that the Army programs are back on track. The tension here is palpable. If the next earnings report shows a beat, we could see a rapid move back towards $5. If it's a miss, $2.50 is likely the next stop. For those of you using Fidelity Brokerage or Schwab Intelligent Portfolios, you might notice that these smaller AI stocks aren't always a huge part of your automated holdings. That's because the volatility is still quite high. But for a self-directed investor, the opportunity lies in the information gap. The mainstream media is obsessed with whether Apple stock is going to launch a new car or if Tesla stock is going to hit a new delivery record. They aren't spending time analyzing the backlog of a mid-market defense AI firm. This is where you can find an edge. By understanding that the financial foundation has been rebuilt, you are already ahead of the person who just looks at a one-year chart and sees a downward trend. To wrap this up, the central insight here is that BigBear.ai has successfully transitioned from a distressed asset to a growth-oriented technology firm. The expectation was that they would run out of cash and fade away. The reality is that they have one of the strongest balance sheets in their peer group after a massive capital raising campaign in 2025. They are no longer fighting for survival, they are fighting for market share. While the intraday movement of $3.12 might seem boring,